Good evening, everybody, and welcome to the October 2020 edition of the Investing Roundtable. My name is Mark Robertson. I'm founder and managing partner of Manifest Investing, one of the co-sponsors of this event, and I am joined here by my three fellow Knights of the Roundtable, starting with the second guy from the left in the second pumpkin, Ken Kavula, from mid-Michigan and a nationally renowned educator. Good evening, Ken.
Good evening, Mark. Good evening, everybody. Feels like I've been sitting at my computer all day today. It feels kind of nice.
Yeah, we know the feeling. I've been in a series of about 6 meetings all day long, so I know the feeling. And to the far right is Hugh McManus from California. Again, Hugh is kind of grounded by the pandemic and has been around at a lot of stuff here lately, and we greatly appreciate your efforts, Hugh.
Hey, everyone.
And notice that
I'm not participating in the pandemic. I have to say, touch wood, I haven't caught the virus yet.
All right, and last but not least, up at the top, rising out of the great pumpkin that he's part of, is Cy Lynch from Atlanta. Good evening, Cy.
Good evening, Mark. I'm impressed that I'm over and above all of y'all tonight.
Looks like you have your sound equipment all kind of stored inside the pumpkin along with you there, Cy.
Yeah. It looks like it.
Yeah, he never misses a chance for a chance to preach. So good stuff. All right, let's go ahead and get underway. All right, you guys all know the drill. No investment recommendation is intended. This is an educational demonstration, and everything we do here is for illustrative purposes. And we're just basically demonstrating the techniques and methods of the modern investment club movement. You'll hear opinions from us. We might talk about real companies in real time. We might even own some of the companies that we talk about. So keep that all in mind. If you'd like to have an automated email reminder of this event, you can send an email to nkavula1@comcast.net. You can also go to the betterinvesting.org webpage, look up the Mid-Michigan chapter, and sign up at that location also. If you'd like a copy of the slides or if you have follow-up questions, as Ken was saying, we will stick around for some questions afterwards, but you can send me an email at markr@manifestinvesting.com. All right, here's the festive agenda for October 2020. Our standing agenda, we're basically going to say welcome, especially if you're here for the first time. We do keep this kind of casual. We will open up the hot mic for somebody who's out there that has a question. We do try to manage the time, but we will also leave it for an open Q&A that you see at the bottom there. We will discuss our results. We do have some hot seat stocks to talk about. You can see the 4 stock presentations, the selections listed there. There is an audience poll at the end of the session, and you are all invited, even if you're here for the very first time. We might talk a little bit, even in the open session at the end, about the spooked markets and turning.
Mark,
yes,
I'm getting messages that people are seeing 2 windows. They're seeing a lower window with the active slide, and they're seeing an upper window with Hugh's name in the lower bottom left. Are you seeing 2 windows on your presentation screen?
I am not. I mean, I can go on.
It's you need to click, it's a new screen by GoToWebinar, and it was showing the webcams, and you can click the upper left box and select hide webcams since we're not using it, and that box will go away. You can also minimize that by sliding it up also, but that won't get rid of it, but hide webcams will.
Okay, so that's on an individual attendee basis. Everybody has that to take care of.
Oh, Mark, you did something that moved anything large.
My webcam was on for some reason. Sorry for saying this Halloween, but it's off now.
And I'm assuming, Mark, that whatever you did fixed it for you, the viewers, too. Folks, if you're still seeing 2 screens, would you say something to me in the question box so that we know? I'm not getting any of those messages anymore. And in fact, I'm now getting messages that everything looks fine, Mark, okay?
Okay. That's the way we like
Yeah,
it.
I don't see the option that I was talking about either. So
No, well,
Okay, nobody else has to tell me now. I got it. Thank you.
all right. All right, let's go ahead. And again, we've been doing this since July 2010, so we've been having a lot of fun along the way. The whole idea is to share an idea and the analysis methods and techniques with the audience. We do keep track of what we do. We keep a few non-core, very special situation opportunities as part of the portfolio, and we keep track. We want to beat the long-term Wilshire 5000 total stock market index by 5 percentage points. That's 500 basis points. So that's what we're aiming for. And as this slide shows, we've been pretty successful about it. Over the 10-year period, the annualized rate of return is running at about 17.5, outdistancing or beating the Wilshire 5000 by basically about 6 percentage points, as shown there. Here's the other more traditional look that we've been using for years to show that we didn't exactly do it right out of the gate, but it has been a work in progress, and we have kind of reached that land of our target range, beating the market by at least 5 percentage points, and we've been there for a few years now. The actual absolute rate of return annualized since inception is 17.4. The total stock market as measured by the Wilshire 5000 index checks in at 11.5. You simply subtract one number from the other, and you get the relative return, which is simply a measure of how much you're beating the market by. So about half of our selections have outperformed the market, and it's been a pretty good run. Questions, Ken?
I have a hand in the air. It's Phil, and Phil, I'm going to unmute you, and you're free to speak. Go on, Phil. That was an inadvertent hand. He ran away real quickly. So we're back to you, Mark, okay?
All right. So again, high fives around the water cooler. We continue to persist in this area. Had some pretty decent results from some of the individual stocks we'll talk about in a minute, but I would say full speed ahead. Any thoughts or comments, guys? Hearing none, we'll just keep pressing on. Here's the actual top 20 holdings in the tracking portfolio. You can actually get to the tracking portfolio. You do not have to be a subscriber at Manifest Investing. This link will take you to a listing, a dashboard showing all of these characteristics and showing you the entire portfolio. What is displayed on your screen is the top 20 by the size of the positions. In other words, the dollar value or the percent of total assets. These are the top 20 positions. The legend up at the top can be used to determine how many times a particular selection has been made. What we do is anytime a knight or a guest damsel or the audience makes a choice or votes for a stock, we invest $1,000 into it. So in the case of the number one holding, Microsoft has actually been selected 5 times. You can see that there. So $5,000 invested in Microsoft is now worth $47,309. So pretty good run for Microsoft over the years. Cognizant, we were talking about in the green room. You can see it's also had a pretty good run, but it has been the most popular, most frequently selected stock over these last 10.5 years. So any comments on the portfolio? Any names jump off the page?
Well, I think we have a new one to the list. Isn't Biospecifics new to the list this time, Mark?
Yes, and it's in the process of disappearing.
Absolutely, yeah. But it sure is nice when one of our small ones gets eaten up by somebody else and they pay a nice price for it.
Yep, we're going to have to sell that one off because Endo Pharma is buying it for basically $88.50, and that was a pretty good size gain for us overnight. All right, any comments on the portfolio averages? Ken, why don't you go ahead and give us your quick report card assessment?
Well, I'm pretty happy with the portfolio until I get to par. The growth number is just slightly under 12%, and I think that's a real good place for growth. That's sales growth, and that's an aggregate number. It's a weighted average. So I'm pretty happy with that. The financial strength number above 80, I'm very happy with. I always like to see straight earnings lines, and I'll take any number a little bit higher than 73, but 73 is okay for EPS stability. I'd rather it be closer to 80 or 85, but I'll take what they'll hand me here. I really like our quality at around 85. That shows that we're doing a really nice job on focusing on one of the most important metrics, which is a high quality growth stock. I just wish the par were a little bit closer to 5 points above my par. My par, if you look up in the upper right-hand corner, is at 8%, 8 plus a little bit. And so you go 5 above that, that's 13.3. We're about 3% above that, a little bit less than 3%. So that's good, but I'd like to see that pushed up a little bit higher. And of course, the way that you increase total par is you sell low par stocks, or you continue to buy really high par stocks, and you push that average up. If we have some stocks on the hot seat tonight, I would be seriously in favor of moving out some larger holdings that have low par and trying to move our par even closer to that 13.3 if we possibly can.
Yeah, one of them that we won't have a choice on is Biospecifics that just now made the list, but that's going to go away.
I was going to throw in a comment as well.
Yeah, go ahead.
Can you hear me? Okay.
I'm sorry, Hugh. I didn't hear exactly what you said.
No, I just said I was going to make a quick comment.
Yeah, go ahead.
Well, so first of all, you're not you, Kat. There was a question in the question box. It's a question that comes up a lot. It's a good question, and that is to define a core holding. And the question was directed to you, Mark. But before you do that, I was going to say one of the things, and I'm not trying to create work for you, which means I'm trying to create work for you. One of the things I often do is to carve out core holdings, companies that I would never think of selling, from things like Ardelyx, which is sitting there like a sore thumb. And I wouldn't have bought that company with the intention of keeping it forever, because I know it's a company I'm going to get rid of. It will drive down a portfolio of some of the things I buy, but these are companies that I don't intend to hold forever. I'm using them to generate cash, to use that cash to buy companies that I can hold forever. So I just wonder if a second look was taken at the portfolio with just what you would define as core holdings, how would the metrics for assessing the quality of that portfolio look? I think they would improve immensely, well, reasonably well.
You know, that's a fascinating topic, Hugh. As Ken and I have actually done a fair amount of work with a number of clubs. A club called the Plungers here in Michigan did precisely that, where they separated out their non-core into a separate portfolio so that they could consider them separately. So half of the investment club did core and the other half did Ardelyx. I mean, Ardelyx is a great example of a company that I don't even know if they have earnings yet. Do they have earnings yet, Hugh?
Oh, no, of course not.
Ardelyx doesn't. So Ardelyx. Yeah, so that's gives you an opportunity to isolate those, and that maybe we do have a discussion about a plunger type approach, Ken, that could make some sense and relieve some of the pressure.
I'd be willing, after we finish with our conference 2 weeks from now, I'd be willing to sit down and play with that for a little bit with you, Mark. That certainly sounds like it's very interesting. Yeah.
And you know, and the short version of that story is that club was ready to explode or implode or whatever. They were literally going to disband, so they had charter disbanding documents on hand, and we talked them into that separation, and they've been going for, I want to say, the better part of 6 or 7 years since then, and just having a blast. So maybe we do that, if nothing else, as a demonstration of that approach.
Mark, we have some new people today with us. I don't, at least I don't recognize their names. And we're getting some questions that maybe, while a lot of our audience would understand, maybe we need to address again. We have a question about why is the par underneath Air Lease an amber color? Can you answer that real quickly for us?
Yeah, basically what it comes down to is sometimes companies' stock prices will dive while their fundamentals could perhaps still be intact. But basically what happens under those conditions is the return forecast, or the par. The par actually stands for projected annual return. So the return forecast becomes elevated. And in this case, we think of it as potentially too good to be true. Or just like you would think of it while approaching an intersection. And unlike some of us in the audience that would, when you see the light turning orange, you step on the gas, yellow generally means caution as you're entering an intersection. Same thing is true. Anytime you see one of those in yellow, just be careful, double check your work, and in many cases, just demand quality from the companies.
We have another question from one of our newer folks, and they would like to know, why is the par on Gentex so low, and where does the par come from in the first place?
Probably the best way to demonstrate that is go on and talk about our hot seat stocks, because we focus in on the par for individual stocks as we subject them to the hot seat, to the challenge.
Okay, and one last question, Mark. Would it be an opportune time, now that we know Biospecifics is entering into an agreement to be acquired? Would it be time to just move it out of the portfolio now without waiting for anything else to go on? It seems to be near the price that it's going to be bought at. Should we just move it out of the portfolio? And you're anticipating those questions by the next slide, I think.
Yeah, I think so. I think starting with the bottom of the slide, you can see that it's been selected 4 times, twice by the audience, once by Ken and once by me. And we've got really nice gains overnight. I think it went from 50-ish to 88 within a period of a couple of days, or 60-ish, whatever. It went up quite a bit, nearly 50% over the course of a couple of days. And you can see that the relative returns over here, these first 2 will make the all-time leaderboard, and these are all really nice. So yeah, I think it's call it a win and walk away. There's a chance that you could get a Green Knight, which is a company writing in and offering a higher price, but I doubt it. I think this is an example of a company where we just simply celebrate a pretty good situation. Anybody else?
Yeah, especially, Mark, since Biospecifics already partners with Endo in almost all the work that it does. Most of Biospecifics' revenue comes from royalties that Endo pays it for the use of one of its compounds that it discovered and did research on. Biospecifics itself only has a drug for 2 indications, and the rest of the earnings come from royalties from Endo. So Endo, I think, has just decided it's better just to swallow it up than to keep paying royalties.
Yeah, and I do think that they're looking at that injectable option as something that can be extrapolated also. And that Endo wants all of that, I think.
Yep, I agree.
All right, so that is one of the companies that was on the hot seat, and I think that's a fairly easy slam dunk. The others are the companies with the lower return forecasts. And, Gentex is one that's under 5, but these are actually very, very high quality companies. So we would want to see those projected annual returns drop down fairly low before we would walk away from them. And we basically have to decide, do we really think that that we gain much? We've been very aggressive about trying to raise that overall portfolio par, and we've done fairly well. The problem is our stock prices keep going up and driving our return forecast down. It's a really wonderful situation to have. But what I thought we would talk about for just a minute, especially Sai, since Sai is the champion of cognizant technology, just maybe take a look at some of what's gone on there. Gentex fits into this mold too, where they're actually chugging along pretty well, but their stock price has been moving up fairly steadily over the years. So here's a look at the case study on cognizant technology. And Sai, would you like to kind of give us the view from 35,000 feet on cognizant?
Well, I think the biggest issue with Cognizant, well, there's probably three major issues going on with Cognizant right now. Two impacting the business, and one impacting the market perception, perhaps, of the business that and we already alluded to some of them. Cognizant's just hitting the law of big numbers. It's getting bigger and it can't grow as fast as it has grown. Now, I think that the analysts, to include Value Line, have probably, that you're showing there at a 5% growth by Value Line. I think Manifest default consensus is around 4.5 or 5. I think that's probably on the low side. I think Cognizant, much more realistic, is somewhere in the 8, maybe even 10-ish perhaps percent, but it's definitely fallen into a large, slow growth company, I think, going forward. It's not doing that right now because of the second thing that's impacting its business, which is the worldwide recession. Although I think the company is relatively well positioned to do well coming out of that. Consultants have I have not looked at Morningstar to see what they say about Cognizant's moat right now. I know historically Cognizant's had a bit of a moat, and I suspect that it still does because consultants, there's some synergies and so forth there. Institutional knowledge that gives a little bit of disincentive to changing outsourcing situations. And then the third is the change in leadership and just kind of what's going on with the company. That's not so much of a business issue as a market perception issue. And the more recent price run-ups that we've seen on Cognizant, I think, shows that the market's viewing it more favorably. And you see some business turnaround because of coming out of the recession or whatever. I think that we'll see Cognizant price rebound a little bit, but we're not going to see the fast growth either of the company or of the stock price. I don't believe that we've seen, in past years. The one thing that, and I'll just throw this out as a comment, because we did it somewhat with Apple. You ran into it some with Apple and the considerations, and I see it the same thing with Cognizant here. The portfolio has gotten huge. It's over 300,000. I think pushing 400,000 actually. 381. We invest a maximum of rarely 6,000, usually $5,000 a month. That's not going to budge anything. If this were a real portfolio being managed rather than just a tracking portfolio, when you sell, let's say 26,000 of Cognizant or some portion thereof, you reinvest it, which that in and of itself can give you, taking 4% par here, which I think is probably on the low side, but let's just accept it. 4% par, you invested in a 13-14% par, you significantly can impact that bottom line. We don't do that. So even selling $26,000 in Cognizant isn't necessarily going to significantly change the bottom line when you don't reinvest. All that to say, I'm not trying to complain about the tracking portfolio. I'm not even trying to advocate leave Cognizant alone. I'm trying to caution anybody listening to this and anybody seeing the results of saying, oh my gosh, Cognizant or Apple or Gentex are huge sells because the roundtable just sold it. All it's saying is that the roundtable is trying to boost par somewhat and taking, to go back to our core, non-core, taking a core holding and you're almost forced to sell a bunch of them because of the way where if you were reinvesting the proceeds, you wouldn't necessarily need to sell as much.
Good point. Yeah, and the only other thing I would add to all that, Si, is that I do think we see the analyst consensus. These are estimates for 2021 and 2022. They, for whatever reason, believe that the global recession may come to an end. And I think it is important, as you may have noted just a few minutes ago, that this trend line through the sales history and forecast is at about 8%. So it's not a completely incredible situation to think that's a reasonable expectation, and the analysts have been ratcheting up their expectations. Now, with respect to the question as to the formation of a return forecast, it basically comes from this picture, where you're basically looking at the sales characteristic, looking at the trailing 12-month sales and growing it over the next 5 years at that 8%. And then attaching a projected net margin. Again, you can see what the net margin has basically been looking like and is expected to look like as your second major milestone. Combining it with the third major milestone, which is the PE ratio. And Saya also alluded to this. These guys are maturing. The growth rates are slowing. The PEs are gradually in kind of a glide pattern down. So that is the third important milestone, in this case 18. It generates this projected return. So you can see, and I fully expect that we will see a bit of a drift up in the return forecast based on the influence of the analysts. And I guess I would lobby for just leave it alone and see what happens for a while. We've had it for a long time, and the next major update is, I believe, 2 weeks out, or it might be next week on the company.
I wonder if that answers the question that I'm going to ask, Mark. When do we see this 10.8 par value kind of percolate into the manifest site itself?
I think it'll probably come with next weekend's update. Some of it'll percolate back up. Again, anytime that the analysts ratchet up, and sometimes they do it rather slowly, their sales forecasts and their earnings forecasts, that obviously precipitates into this type of a number. That's the consensus. Value Line is still pretty pessimistic. We'll see if they actually improve their outlook. But yeah, it should be visible within the next week.
Maybe I've been doing too much thinking about proof and too much back and forth in the calculation. But when proof comes in as close to a par value as this proof value did, it's down there 1, 2, 3, 4 lines beneath what you have marked at 10.9. When it comes in that close, I think it gives a lot of extra underpinning to the validity of the number that you're coming up with in your par, and with that as a par that is on its way, plus the fact that we're still a long way from money market returns when it comes to Cognizant, and our total par in our portfolio isn't as close to my par as it has been in the past, at least. Maybe it is okay for us to kind of sit back and give it a little bit of breathing space. I'll balance that with the fact that it is one of our largest holdings. I mean, when you have a tracking portfolio and one of the stocks reaches 3.5%, 4% of the portfolio, that's a pretty big chunk, no matter how you look at it. Mm-hmm. So, this is an old tracking portfolio. It's been around for 10 years now, and I could probably vote either way, but I'd be willing to join you gentlemen and say, let's sit and watch it for another month or two and see if the par does move back up into a range that is more conducive to the kind of stock we want in this portfolio.
Yeah, and Ken, I'll just come flat out and say it. I am more and more influenced every single day by that number, and that's a very high number for the average company right now. So to me, it's just screaming hold at me in a big way. We are going to talk about this subject in great detail in a couple of weeks at that conference. Ken will give more details on it in a few minutes.
I didn't want to be that flat out blatant about it, but that's what I think I was trying to say as well, Mark. That
Yeah.
that number is something that I don't see very often.
Yep.
I don't see those numbers in double digits, and I don't see them coming real close to a par value that you calculate like it is on this one.
Yep. We'll be covering that in much greater detail. By the way, that's just a quick reminder that that conference is from the 11th to the 13th of November. It's 5 different sessions featuring a number of topics, and Ken will talk more about it later. So with that, let's go ahead and transition into the stock presentations. Ken would like to present UFP Industries. So take it away, sir.
Absolutely. I'm going to look at a Michigan company tonight. This one's from Grand Rapids, Michigan, and it's been around for a lot of years, for over 50 years. You might have known it as United Forest Products International originally, but it's now changed its name to UFP Industries, and it's a worldwide company, and again, headquartered in Grand Rapids, Michigan. I'm having trouble. Mark is driving. I'm trying to advance the slide, and Mark is the one that has to do it. Next slide, please, Mark. There we go. You can see that they have operations in a lot of Southeast Asia, Australia, North America, and a little bit in the United Kingdom. Nothing basically in mainland Europe, and they're not in Africa or South America at all. Most of the business comes from North America. Next slide. The mix of the business is pretty nicely evenly split between construction, industrial, and retail. The retail slice is about a third. You can see that that's big box, independents, and co-ops. Construction, the middle shade of green, about a third, a little bit more than a third, and the industrial component about a quarter. That leaves a very small piece for the rest of the world at about 5%. Next slide. UFP operates in 3 distinct business segments, and up until this year, they were operating in geographical segments. They've changed their entire organizational hierarchy to move into these business segments right now, and they're labeled retail, construction, and industrial. Next slide. Retail solutions includes an awful lot of things that you would find in the local Lowe's or Home Depot. These are brand names that are UFP brand names, and they stand for everything from plain old lumber to treated lumber to finished products to a lot of halfway finished products that you would use to create projects with. If you're a do-it-yourselfer, you probably have experience with one or more of these brands. Next slide. The construction is things that they build on site, that are built in a factory. They build forms for concrete. They do a lot of commercial work. And I've captured a few pictures just to show you. Next slide, Mark. Just to show you some of the kinds of things that the lumber product goes into. And of course, the UFP is doing the construction of these forms. So it's a value added proposition to the lumber itself. Next slide. And the third component is industrial. They do a lot of packaging, original equipment manufacturing components and panels, and a lot of protective packaging. Packaging is different than protective packaging. Protective packaging might be wooden crates that you build around glass jars, for example. And the next slide again shows some pictures of the kinds of things they do. Down in the bottom right-hand corner, there's wooden crates built around glass jars to keep them safe as they're shipped in various places. Or there's crates built around machinery, again, to keep it safe as you ship it from place to place to place. Next slide, please.
Ken, I need that pump on the bottom slide, on the left-hand side. I need that pump from my mom and dad's house.
That's a pretty big piece of equipment, Mark. I think that stands somewhere around 5 foot tall. So
Okay, maybe
you gonna get that down the basement stairs, okay?
that might make for a fairly high pressure shower. Never mind.
Here we are looking at section 5 in my SSG, and I've given you my judgments up on top there. I'm using sales growth of about 9%, earnings growth of about 11, and that seems to be pretty common numbers when I check the different sources. I'm using the average high PE and the low. I'm not adjusting them at all, and I'm doing a payout ratio of about 15%. That gives me par values of somewhere between 13 and 18. That certainly is higher than the par in the current portfolio. So when you put a stock like this in, albeit a very small piece, you still have the ability to start to push the par in the right direction. Getting a good solid buy, I can expect return on this SSG telling me somewhere between 13 and 18% over a 5-year period, and I'm quite pleased with that. This is a materials company, again, basically dealing with lumber and then adding value to the lumber so that it can create all kinds of other things that have increased margins to them. I think there's one more slide, Mark. I've captured the top line from the UFPI page on Manifest. You can see their par is 13.6, certainly right in line with the par that I came up with on my SSG. And I did capture also the little kind of mini industry study that every stock has, and it shows me the top companies in the lumber and wood production industry. You can see that UFPI ranks second. The top company is a Canadian company, and I'm looking at 2 other companies beneath that, which have about the same quality and which have varying degrees of par values attached to them. I really do think also that this company fits my own thesis that we're going to see a lot of people doing a lot of work around housing as this cohort, this group of people age 30 or so decides they want to own a home. They're not going to be able to move into a new home. They're going to move into homes that need a little bit of work. And I think that bodes well for the next 3 to maybe as much as 7 or 8 years of home ownership and of home improvement. We're seeing it start now with everybody at home, but I think the cohort of people that are at this age right now are going to keep that going well after the pandemic is behind us. So I'm suggesting for addition to our portfolio, UFPI.
Okay, thanks, Ken.
Excuse me.
We'll go ahead and move on to what used to be the Bank of the Internet, and Cy is going to go with Axos Bank.
All right. Thank you, Mark. I guess I have decided to be like Joe Smith or whatever, the late, great Joe Smith, bank analyst for Better Investing educators from New Jersey. I want to own a bank because that's where the money is, because y'all will remember last month we looked at looked at
Truist.
Truist, yes. And this month decided to go with Axos. And you'll see part of why I'm saying that. See, pretty decent up straight parallel lines, a little bit of a hiccup there on the pre-tax profit lines, but even then earnings continued to grow, and that was largely limited to 2 years, and they're back on track. Next slide. I started out by kind of planning to just purchase an existing holding or accumulate an existing holding. So I started with the portfolio ranked by par and started looking for those blue-green companies, which I'll go ahead, since there were some questions about color coding and so forth. The blue is referring to that next to the last column, quality. That is a percentile ranking of 80 or above for excellent companies, and the top 20% of quality ratings on Manifest. And then green, which is in the sweet spot. That's between 5 and 10 percentage points above the MyPar or the median par for all the companies in the database. And you see the first one was Employers Holdings. I'm just not that familiar with Employer Holdings and wasn't looking to dig into it. I think it's an intriguing company, but scratch that one just because I don't follow it very closely. EPAM and Google, you see, I am familiar with both of those, own both of those, hold both of them in my growth stock outlook column, but the PE there for EPAM is rather high for me as far as a projection, and Google and EPAM both were larger shares of the portfolio than I really wanted. Then you get down to Universal Display. Again, PE was a bit pricey. Facebook, I just don't like as an investment company. That's my own personal opinion. Make your own judgments, which got me down to First Financial. I did my own audit of First Financial bank shares. Didn't quite get that return. It's still a good, solid company. I almost went with it, but decided let's look at regional banks generally, see if there's a better potential return. Next slide. So when I do industry studies on Manifest, I like to rank by quality usually first. Looking for the high quality, you see First Financial is the highest, and right there is Axos, formerly Bank of the Internet. And it also has the highest potential return of all the companies shown in this top quality sector. So I said, that looks intriguing. Let's continue looking at it, see how it compares to growth in the industry. Next slide. Ranked all the companies by growth, and it has by far the highest potential growth rate according to Manifest projections for the industry. And again, it's the second highest potential return of the companies on this slide. So I said, yes, this looks like a good company to study. So I decided to dig into it a little bit. Next slide. Axos does have an investor site. It's not easy to get to off their main website. So I just decided for this particular presentation to get some general information about the company off the main company website and just give you some flavor, and then I'll supplement it with a little bit of specific financials, and we'll look at the projections. What kind of looks nice to me about the company, as they call it, they're born digital, and then they focus on digital. Internet bank, Bank of the Internet. They've been around for 20 years, or just celebrated the 20th anniversary this year. And they started out online, and they're primarily online now, both for loan acquisitions as well as deposit and investment. Next slide. Here's just some things the company says about itself. They are trying to get human insight and digital expertise into meeting the company needs. They offer basically the full range of financial products that you expect from broad financial companies, all sorts of banking products, investment products, as well as loans and retirement accounts. Next slide. Started as a digital bank. They're now $12 billion in assets. So they're growing as a regional bank. They have headquarters largely in California, but spread throughout the country. And they seek to give competitive interest rates. They provide low to no fee accounts and seek to be somewhat of a non-traditional bank. Next slide. Here are my judgments and bottom line. Before I get to that, one thing that I expected, given its emphasis on digital marketing as well as digital acquisition of both loans and deposits. I thought this company, and I'd already gotten a hint from the manifest margin that I alluded to earlier, which said the net margin of 17% compared to the next high margin of excuse me, that was growth. But they I gave me the impression that they would be high margin as well, given the par. Two things that I look at in banks, really three that help me, are called the net interest margin. That's how much money they make on their loans, loan margins versus what they pay out. And they've had a very solid net margin of about 4% over the last 5 years in both rising and declining interest rate markets. That's a good indicator. They also have a return on assets above 1.5%. Right now, the average big bank is about 1.1%. Average regional bank's about 1.2%. So their return on assets is excellent. In the upper 5% of all banks. And then finally is their efficiency ratio, which is how well they control their non-interest costs. Again, they are in the top 5% of all banks. Their efficiency ratio is about half of the average. It's in the mid 30%, which is outstanding. So this is a well-run bank that seems to fit both the move to online banking as well as, they point out, some of their growth potential has perhaps been accelerated by COVID and the desire to do more things online. So here are the judgments that I used factoring into all of that. I did a growth rate of 14% based roughly on the last 4 years. Compares to 27% over the last 10 years, but they've been pretty steady at 14 over the last 5, and that looks reasonable. Then the pre-tax margin and taxes to come up with a net margin, and dividing by shares outstanding, I came up with a $5.87 on my SSG, compares to manifest of about 711. You see my high PE, I use 16 times, and the average is 10.5, which is a little above manifest's consensus average of 8%. Next slide. That all gives me a potential high PE return of 27.9, but the average PE return, which is more comparable to the manifest par, is 17.6%, a good, very healthy potential return with some potential upside the higher that PE goes that you see here. But the 17.6 is very comfortable, and so I add Axe, formerly known as Bank of the Internet, to the portfolio.
Thanks. I have to get you to come out of the banking rut here pretty soon. Go back.
Well, you're about to take away Cognizant or something, so I'm.
Oh, you'll be back.
Going back to banks.
All right, so let me go ahead and start with some quick external screening results. This is what we refer to as our parade of opinions. I'm basically looking for companies that rank in the top 10% of all companies. When we talk about the manifest rank, it's a combination of the return forecast, the par, and the quality into kind of an equally weighted index, if you will. So we like to talk about companies that are in the 90s. I will plug Versailles. His bank is right there at 100, down at the bottom of the page. But what I was looking for is companies that have a decent positioning with respect to their return forecast and their quality rating. And then I wanted to see a double digit. Ken alluded to this when we were talking about Cognizant a few minutes ago. Double digit projected return on value in combination with a relative strength index in that 20 or 30 range. So that's what I'm looking for. Just kind of eyeballing this list. I also want companies that are trading as close to their 52-week low as possible in the tradition of Hugh McManus. And you can see there's a couple that are really nice, tucked down around their 52-week lows. We like to see them in that 20% striking range. Obviously, double-digit returns from a value line analyst is a good thing. We like to see Morningstar's price to fair value and the analyst consensus price to fair value under 100 where possible. And again, just kind of eyeballing the list, I couldn't get away from CBOE Global Markets. The ticker is CBOE. Really nice projected return. It's good quality, not excellent, but good. Double-digit projected return on value, and a relative strength index down around 30, suggesting that it could be a punished stock price with some room for the upside. Again, trading near the 52-week low with a decent return forecast from Value Line. Morningstar thinks it's fully valued, but the analyst consensus, which I give a little bit more weight to, thinks that it might be on sale. So we're going to go ahead and dig a little deeper into CBOE. The company is headquartered in Chicago. It is the Chicago Board Options Exchange, affiliated with the Midwest Stock Exchange. And the way I would characterize it is they have investment-related products, from options to futures to some equities. They do some index-type stuff, but a large portion of their business is the business of getting paid for managing or building products related to fear. Yes, you heard me right. Related to fear. Fear as defined by volatility. If you want more on the subject, look up anything Cy Lynch has done on how volatility should not be frightening, and it certainly is not risk, but there's an entire industry, folks, based on risk, volatility, and fear, and they sell a lot of stuff. So I find it almost kind of heartening to have the potential to make a reward off of these people who are basically taking care of something that we don't pay a lot of attention to, that being the fear associated with volatility in the stock market. So I'm kind of a little smile on my face, and I'm hoping that this one works out, because that would be a really nice, warm feeling to make a little bit of money off of this one. Here's a look at the stock price chart over the last 10 years or so. You can see that it had a real nice run up from their IPO and has basically relaxed and compressed for the last 3 years. You can see that the relative strength index, yes, indeed, is approaching that 30 level. So we're basically at levels that we have not seen for about 4 years with respect to the stock price. Here's a look at the visual analysis, the business model for the company. Major acquisition here, which means that the history from 2010 through 2016 can be noted, but de-emphasized and disregarded. We're paying attention to the new company as it is today. So we're talking about a $3 billion company growing at about 7.5%. You can see that the projected net margins post-acquisition have been down in the 15% range. So that's what we're using here, much like the value line analysts. You can see that the PE has been kind of floated around a little bit, but it's somewhere in that 20-ish range. So the PE is 22.5 in this analysis. So again, $3 billion company growing at 7.5%, generating 15% margins, and a PE in the neighborhood of 20 leads us to a projected annual return of, call it 13%. That reconciles pretty good with the projected return on value. Again, the relative strength index indicates that this company could be undervalued or punished, if you will. Value Line likes it. Really nice characteristics here on increasing earnings. Pretty good situation. Again, a projected annual return in the low to mid-teens, and find that fairly attractive. We often like to share the Value Line close, which is the last paragraph or two from the most recent Value Line report. They have been managing their capital pretty well. They are increasing dividends and looking to buy back some shares, as it says there. And again, it's had a fair amount of momentum, even though it's been stuck in the mud for about 3 years. But it has a pretty good outlook, according to Mr. Seidman. for the next 3 to 5 years. So I'm going to go ahead and add some anti-fear to the roundtable tracking portfolio. And we'll take it away with Hugh and his repeat selection of BP, because he apparently thinks that oil and natural gas isn't going away anytime real soon.
Yeah, I'm taking a bit of a gamble on that one. But yes, I am adding yet more BP because the price has dropped even further. I thought 2022 was kind of a low. I knew they were going to slice the dividend a little bit, cut it in half, which is fine. It's not fine, but it was anticipated. But it's dropped a good third since then. So if it was good at 22, it's even better at 15, 16. So we skip along to the next slide. I think this, yeah, the process that I have really is to generally look at things that I've bought already and add more if the price is good. And I can tell you, Gilead looks delightful right now. I think it actually hit a 52-week low today. Certainly companies like Gilead and Biogen, two major pharmaceutical companies, are sitting near the 52-week lows. And I would suggest those of you interested in bolstering your pharmaceutical exposure in a portfolio might want to take a look at Gilead right now to see if it has of any interest to you. But all else been equal, the first thing I do is look for low prices, make sure the quality of the company is sound, and if I've owned it before or I own it in the portfolio or bought it recently, I tend to buy more. So that's the driver for BP. Had it not been BP, it would certainly be Gilead. Skipping along, BP, by the way, is currently at almost a 30-year low, I think. I can double check that later, but it's pretty low. But with the company, not a lot has changed. The company did report a profit today, actually, about 6-7 hours ago, based on how it measures profitability, replacing oil that's pulled out of the ground. And oil prices are still pretty low, and they were hit further today. I think the speculation of another hurricane in the Gulf might help them a little bit, but you know, things aren't looking well for oil. And ultimately, in the long term, there's a big move against fossil fuels, and companies like Tesla will push it in that direction, not simply because of the electric cars, but also the technology that they're installing today in Southern California and around the country with these extremely interesting solar roofs that they're putting in people's houses. But it all bodes well, doesn't bode very well for fossil fuel companies like BP. But BP is pivoting in that direction, and probably more strongly than some of its peers. At least that's the impression that they're creating. Skipping along, this is what's been happening to the price. Little graph here. Sad to say that in July it looked low at 22 and change, but as you can see now, almost 16 bucks a share. It's looking even more attractive, at least to somebody like me who doesn't panic when dividend yield goes up to 7.5%. Perhaps I should. So I would be very tempted and will add more to the tracking portfolio. I don't intend to keep BP forever. This is a short-term thing for me, and much as that's anathema to the instincts that I've developed and cultivated thanks to NAIC/better investing, I have benefited from buying companies for the short term that will pop in some way and create money so that I can afford to buy quote-unquote real long-term companies that I would never plan to sell. Companies that would have to convince me with a very good, strong argument that they need to be fired from the portfolio. So skipping along, just to reiterate what I said before, oil isn't what it used to be. But the fact of the matter is that while there is going to be a push towards renewables, there's going to be a little bit of molasses that will slow down that progress. And the fact is that the discovery, distribution, and consumption of oil has a huge, globally, multi-trillion-dollar infrastructure behind it. If that could be utilized for something else, yeah, that would speed things up. But the fact of the matter is it's not going to go anywhere, and it will fight back, and it will slow that move. And as we get out of this recession, or this pandemic, and we will, oil recovery demand will come back. It always has. Ultimately, about 1 billion barrels a day, 1 million barrels a day, excuse me, has been out of the global oil demand for the last 20, 30 years. I don't see any reason that shouldn't continue, but I do see that it will slow down. I think a pivotal year will be It's a normal year for an economy. There's no recessions or anything like that. But global demand for oil actually dropped below a million. The increase in global demand dropped below 1 million barrels a day. That'll be very telling. That's going to happen maybe 5 to 10 years. It is on the horizon, but not immediately. And as I said, BP is pivoting in that direction. I think we skip on. It's maybe the last slide. So that is, I don't know when things are going to recover. I know they will. BP is looking to me a lot more seductive with its low price. And nothing else has changed, by the way. I think its earnings engine will be intact, and it will bounce back aggressively when the economy starts to recover and that virus is finally put into where it belongs, which is in freezers in 5 or 6 labs around the world that will torture it periodically with experiments, but it will not be out on the loose. And over the next 10 to 20 years, yep, we're going to see big changes in terms of fossil fuel, but it will happen gradually. There'll be a few moments, of course, where technology will push it aggressively, but it's not going to be an overnight thing. And companies like BP, if they're aware, will have time to adapt. So I just can't stop myself. I have to add more BP to the portfolio. For now, at least.
We need an intervention. No, I'm with you. It's an extremely interesting value opportunity, but Ken, we can go ahead with the poll.
Sounds good, Mark. Give me just a chance to get everything ready to go. And the poll is open, folks. Help us out by choosing one of these 4 stocks or choosing none of the above. Well, that was a quick rise to 3/4 of your voting. Let's try to get that vote up to 85, 90% if we can. I'm going to count down in my mind from 10 and then close the poll. And we're going to close the poll and share the results. And it looks like UFP Industries took the lead at 40%. So we'll put an extra holding for UFP into the portfolio.
So your groupies are Halloween happy.
We had a number of comments, Mark, about you having the Halloween theme tonight with your fear theme going on. So they felt you were right on line with it tonight.
Oh, it should have been a slam dunk then, is what you're telling me. Oh, wow.
Well, Hugh didn't help himself being a little oily, you know.
All right.
So I'm going to hide these now, Mark, and we're going to our bull sessions, which we're running on Tuesdays at 2 p.m. If you've never heard of the bull session, it's just a conversation. Sometimes Mark and I show up. Most of the time, Mark and I show up, and sometimes Kim Butcher shows up, and Hugh has been showing up on a fairly regular basis. You never know who you're going to listen to. It lasts for about an hour, and it's on Tuesdays. If you'd like to register for bull sessions, you need to go to Manifest Investing, but you don't need to be a member. You can register on the non-member side of Manifest Investing if you click on events. There's a registration link right there. Our November roundtable will be held the first day of December. So please keep that in mind. We're not going to try to intrude upon your Thanksgiving Tuesday, but we will run the roundtable for November on December 1st, and we'll run the December roundtable on December 29th. Meanwhile, our Stock Pickers Breakfast, which this year is a webinar, We're calling it Successful Investing 2. That's going to be on November 11th, 12th, and 13th. The times are in the late afternoon on those days. If you want more information, go to the Better Investing website, look for the Mid-Michigan chapter, and make sure you click events on the Mid-Michigan chapter if you're looking for the Successful Investing Conference. It's also on the Manifest Investing website under events. That's where you can get registration details. If you're having trouble finding either of those sources, drop Natalie or myself an email. My email is kkavula1, KKAVULA1 at comcast.net. Natalie's is nkavula1 at comcast.net. And we'll be glad to send you URLs so that you can register for one or as up to the 5 classes that are in the series. There's 4 classes and a Let's Talk Stock panel at the end. We think you'll have a good time. We think you'll learn something, and we think you'll walk away with some pretty decent ideas from successful investing to the stock pickers. Mark, I'm going to turn it back over to you.
Okay. Just a reminder that we do put all the roundtables on the YouTube Manifest Investing page, so you can see that there are some of the bull sessions and the roundtables. You can actually go back, and if you're curious about what we will be doing in November, very similar conference back in May. In fact, you can access all of the sessions under playlists and catch them there if you would like. But again, subscribe if you'd like to get automatic reminders and nudges when we post content there. With that, I think we'll just say thank you all. Good night, everybody. Thanks to everybody for your efforts and contributions. And have a happy Halloween. And I think we can stick around for a few minutes for a Q&A if there's any interest in that. So
I think we have a few questions to get answered. Thank you, folks. Good night and have a great Halloween.